Hi there, my name is Randy Helm. Welcome back. Today we are on part 2 of a 3-part series. We are going through the actual process of putting together projected financial statements. It's pretty easy if you use a template like I am. I'm working with the template that I created. You are certainly free to use your own. Now if you're ready, let's begin. So the first thing we want to look at is our revenue growth. These numbers here are populating from the historical information we put in there. And we can see that the growth rate for 2021 was 6.4%, and for the next year it was 6.3%. So then we have to make some sort of assumption about what is the growth rate going to be in the next few years. Right now I have in there 6.3% because that was the previous growth rate. But I can put in there whatever value I want. Let's say I want it to grow by 8% in 23 and 24 as well. But maybe in 2025 it's only going to grow by 5%. Now the next section is gross margin. We've got some gross margin numbers from the previous 3 years, what the average was, the minimum, the maximum. So from that we need to make a guess as to what the numbers are going to be going forward. It's defaulting in with the average of the 3 years, and I'm going to go ahead and leave that like it is. You can certainly make it go up or make it go down as you think the future will dictate. So the next section is on payroll, and we've got payroll expense for the previous years and what percentage of revenue is our payroll. So you can see that in 2020 the payroll was 17.5% of revenue, and then 17.1% in the next year, and 16% in the year after that. So what do we think the payroll expense is going to be as a percent of revenue? My template has just used whatever we did in 2022. Now you can go with that, or you can make it a different number. Let's go ahead and, instead of 16.0, let's do 16.5. And we'll just carry that to the next 2 years as well. Next on the list is rent. Our rent has been steady for the last few years, and a lot of times rent is a fixed amount for the length of the lease, or it may increase every year based on different factors. I'm going to just leave it at 0%. But then we have CAMs. CAMs is common area maintenance expenses that you have to pay to the landlord for upkeep of the property. And we can see that in this case CAMs have been pretty steady, but maybe we think that it's going to increase in the future. We can, instead of having it increase by 0%, maybe the growth rate is going to be 5%. So we put 5% in, and that will carry forward. The next item is inflation. So you put in some historical inflation numbers, and you can find that on the internet by doing a simple Google search. The inflation numbers are going to impact some of your expenses in the future years. The expenses that typically increase with inflation. So I put in, my formula here has 5% for each of the next few years. But considering 2022 was 8.3%, maybe the following year, instead of being 5%, maybe it's going to be 7%. And then maybe it's going to be 5% after that. And for 2025, let's put in 3.5%. If you have a line of credit with your bank, this is where you put in what you think the interest rates are going to be. If your organization pays income taxes directly, then this is where you put what you think the income tax rate is going to be for your company over the next few years. This next section has several different line items in it, and often these specific items will either be the same amount year after year, plus or minus a little bit, or they might tend to grow with inflation. So the way I have this, it pulls in the historical numbers for the 3 historical periods, and then in these following 3 years, it uses a formula based on whether it sees it as a fixed item or it's going to grow by the rate of inflation. And if I wanted to change one of these, I can just click on here, and where it says fixed, I click the drop down box. Maybe I change it to inflation, and then the numbers will change accordingly. Say maintenance cleaning, I have it in there at it's going to grow by the inflation rate, which seems to make sense. Supplies, I have it in there as growing with inflation. Maybe it's going to be fixed. Let's leave it at growing with inflation. Anyway, you need to make some assumptions about your expense items. Are they going to grow? Are they going to be the same year after year? Now we get to some balance sheet assumptions. For this company, we have a petty cash amount, and this is likely amounts of cash that are sitting in cash register drawers, just for the sake of conducting business with customers that come in the door. And you can see that the number here is pretty steady. In these highlighted cells, we make assumptions about the future years. And I'm going to just leave it as what it has been. You certainly can increase it or decrease it. If you were going to increase the number of cash registers in your business, maybe you would want to increase the petty cash. Those are just some things to think about. Next, we have accounts receivable. If you're a company that sells to your customers on account, then this will be important. If you do not sell to customers on account, you either take cash or credit cards, then you can probably skip this section. What I want to do is look at how the accounts receivable balance has been over the last few years in relationship to the revenue of the business. What we see from this is that on average, our accounts receivable shows that the balance has been the equivalent of 21 days of business. So it takes, on average for this company, 21 days to collect from its customers. Is that too much? Is that too little? Those are things you need to think about. My formula in here says just use the average of the previous 3 years. If you were going to do some major changes in your operations, in your collections process, or how you determine what kind of credit terms to have with your customers, maybe you might want to increase or decrease these numbers. The next section is inventory. So in this inventory section, it kind of looks a lot like the accounts receivable section. So here we have the cost of goods sold for each of the 3 historical periods. We get a figure in here that says, what's the average cost of goods sold per day? And then we look at what has the inventory balance been. And that gets us to a number that tells us, based on our current business, we average about 54 days worth of inventory on hand. Going forward, is that going to be still 54 days worth of inventory on hand? If we've been running out of product, we might want to increase the numbers to have some sort of safety net so we don't upset our customers by running out of product. If we've had way too much product on the shelves, maybe we want to decrease these just a little bit. I would not make drastic changes here unless you had some really good reasons for it. But let's say we did want to make some changes. Let's say we thought having 54 days worth of inventory was way too much. We could gradually reduce it to maybe it's going to be 50 for this next year, and maybe 48 for the year after, and then 45 the year after that. That shows you then what the inventory balance should be at the end of those 3 projection years. Then we get down to the accounts payable section. It shows the cost of goods sold for the historical periods. Again, how much cost per goods sold per day on average. And then what has the accounts payable balance been like over those periods? Now what this is telling me is that on average, that we pay our vendors in about 42 days. So going forward, we can use the same numbers, or we can increase it or decrease it. If you want to delay payments to your vendors a little bit longer, you can increase these numbers. Say instead of 42.3, maybe you have it 50. But I do want to extend a cautionary note here that if you extend your vendors too much, they will get upset and they may put you on a credit hold. So I would not encourage extending your vendors out quite a bit. Maybe you want to get into better terms with them. So instead of leaving it at 42 days, maybe you want to get it down to 35 days. That's still longer than a month, but it's better than it has been in terms of your vendor relationships. Anyway, you have to work through those discussions, see what works best for your company. Now, just like on the income statement side, down here in the balance sheet, we have some more items that we need to decide if it's going to grow with inflation or if it's pretty fixed year after year. Again, I have a drop-down box where I can change these. Maybe I had this at fixed and I want to change it to grow with inflation. Easy peasy, lemon squeezy. If you have a line of credit with your bank, often there is a automatic sweeping of funds between your main checking account and your line of credit. I have this section down here that would say, if your cash gets below a certain number, then assume you're going to draw on your line of credit. Now I have in here 0, but we could say maybe the minimum amount of cash in our accounts is going to be $20,000. So if our account balance with the bank were to drop below this amount, then our line of credit would kick in and we would incur some debt. Now that's it for this general assumptions tab. Well, that was part 2 of a 3-part series. Make sure to join us for part 3. And until next time, have a good day.